Welcome to It Comes in Pints, a Seattle Study Club podcast where we will explore a myriad of topics: clinical, health and well-being, psychological, education, business, and much more. I'm your host, Greg Tice.
Hi, my name is Derek Chan. I'm the managing partner for National Financial Network.
I want to welcome everyone to the latest episode of It Comes in Pints, a Seattle Study Club broadcast with me, your host, Greg Tice, podcast, not broadcast. Today, we're actually fortunate to have Derek Chan joining us from National Financial Network. I think this is appropriate as we approach year-end to have a discussion not just around taxes, but that'll be a primary focus, but to also talk about investment opportunities, what we should be thinking about as the new year gets ready to begin. And to that end, we've invited Seattle Study Club's partner, National Financial Network, and Derek Chan with National Financial Network to join us. Derek actually brings about 29 years of experience in the industry as a financial advisor, VP of investments, wealth management, running a bunch of financial. Derek, welcome. Why don't you tell us just a bit about yourself before you and I cheers and have a drink and move on?
Sure. Thanks, Greg. I appreciate the introduction. My name is Derek Chan, as Greg says. I have been in the industry for 29 years. I started what seems like an eon ago at Morgan Stanley, really advising clients on wealth, financial advisory. I continued my career through UBS Wealth Management. I ran the wealth management platform for HSBC Bank for about 9.5 years. And over the past 12 years, I've really been a managing partner for financial firms. And, in my role and capacity, it's really hopefully affecting, positive kind of teachings and positive change to helping, advisors really be comprehensive, right, in terms of planning for their clients and really the businesses and the people that we deal with. We really touch on a lot of areas, right? Wealth management being one of them, but I like to look at it as really just an overall planning kind of, business, right? We'll help small businesses with just business planning, estate planning, retirement planning, college planning. So, various aspects that I think are relevant kind of to all of us. So,
well, I can tell you that's one of the things that drew Seattle Study Club to you and to National Financial Network. That focus on the comprehensive approach, which obviously ties right into comprehensive diagnosis and treatment planning and what we're encouraging with the group. So there's our shameless plug right up front for National Financial Network and what they do. For our audience, they know, but Derek, this is called It Comes in Pints because the idea is I really just want it to be you and I sitting in a pub having a conversation. If that's the case, we have to have something to drink while we're talking. So what did you bring with you today to share with us?
You know what? I have a athletic IPA, right? It is a non-alcoholic IPA, as I am currently in the office, and I don't want to have people have bad habits. But nonetheless, it's a beer that I enjoy when I just want to be able to kind of have a good beer and stay clear, right, for that.
Absolutely, absolutely. The Athletic's one of my favorites. So I am not going that direction. I am actually having Blanton's. So a little, let's get that on the camera there.
Oh, you see, now if I knew I could bring Blanton's, I thought I had to have like a pint, so. Yeah.
No, you don't have to have a pint, but if you got Blanton's, we can pause and you can go get it and have one.
No.
All right, well, cheers, my friend.
Yes, cheers.
Looking forward to this. All right, so right out of the gate, I'm just going to hit you with I think, the upfront question. Because people selling to practices, to dentists today, and really for as long as I can remember, At the end of the year, tout, I think they call it Section 179, where especially people who are looking to sell major equipment or big digital technology, A, is that really a legitimate consideration? And B, so I'm going to give you a two-part question and let you go. B, how much of a difference in your taxes can it make to do this kind of year end, whether it's 179 or there are other options, or is it not really relevant?
Sure. I think when it comes to, Section 179, I mean, you're talking about the ability for a business to take, a fair amount of depreciation, right, for equipment that they kind of purchase. And we see it very common in dental practices, medical practices. Listen, the reality is that what the practices have to do, it's ever evolving, right? And with that, certain equipment ages, you're going to need to replace with newer technologies, better. I remember when I was used to go and get X-rays, it was very cumbersome, and now it's boop, they take 4 or 5 pictures and it comes up on the screen. That equipment, last time I checked, isn't very cheap,
Right.
right? So the ability to now take that purchase, right, and depreciate it now over the course of a number of years, 6 to 8 years, it does make a substantial kind of difference in terms of pairing off some of the revenues that are generated, right, from the practice. And one of the things that you see that I thought was interesting as well is that in the recent tax act that was instilled, the One Big Beautiful Bill Act, right, the OBBA, as we kind of now get into next year, there is the ability to now take a accelerated, right, depreciation. You could go do a 100% depreciation in the first year, right? So,
Okay,
good and
so
bad.
let me stop you right there. So if you're advising me, obviously not a dentist, but if I was a dentist and I want to buy a $50,000 piece of equipment, I've been looking at it for a while. Today, am I better off buying it at the end of the year, or am I better off, are you saying buy it January 1st and you can depreciate the whole thing that year? Or if I buy it, because if I buy it now, the One Big Beautiful Bill doesn't kick in till next year, correct?
Yes, that's correct.
So which way do I go? Which is to my advantage more, buying it now or waiting until 2026?
Yeah, that's a really good question, Greg, because if you think about it this way, unfortunately, there isn't a like magic answer, right? Like, hey, you should wait, you shouldn't wait, and that's predicated on a lot of reasons. Like some practices, you're gonna want to have a little bit of deductions. Like, I think where the 100% depreciation comes in handy is if you had like a blowout year, right? You had a blowout year, your revenues are higher than ever. If I reported all of this, I'm going to be paying up the wazoo in taxes. Then in those instances, it at least allows a practice to say, well, if I did now this year, we had a great year. And when we have a great year, you might think about, well, we're expanding, we're growing, and we have the ability to replace certain equipment. Now you have the ability, at least within that year, to now purchase a piece of equipment, even things like office furniture and things like that, right? Not just heavy equipment, but then have the 100% depreciation kind of go and really offset, right, whatever revenues are in that year. And I say that it kind of, it depends, because the one thing is if you take it all in one year, well, then now the following years, right,
Yeah,
you kind of don't have it. So for some folks, if it's like a steady eddy and you know that I'm getting X depreciated on an annualized basis, it might be a better answer,
right.
right? But to have the ability to have that flexibility, I think is advantageous for any practice owner.
Yeah, a customized treatment plan, basically. However, now that you explained it more clearly to my meager brain, um, it seems to me if I'm looking at a piece of equipment or furniture or whatever it is, um, that, yeah, go ahead and get it this year and get the depreciation for all of 2025, because the 100% appreciation, if what I'm hearing you say is correct, if I have a blowout year next year, I can still do the same thing in December, buy that next piece of equipment, buy that next whatever it is towards the end of 2026,
Mm.
and still get the 100% depreciation next year. And so I'm not gambling. Am I going to have a blowout year next year or not? I have already got that information at my fingertips. Does that make sense?
It does. I mean, if you were to buy the equipment this year, and that should be a normal practice in general, all right? And that's the thing, like why at year end it's important for everyone to kind of just take a look and say, hey, where am I right now? And if you have a strong revenue line and there's equipment that needs to be purchased that can help you offset, right, some of the taxable consequence that comes with, making obviously more money, then you could buy the equipment this year. Just know that it would just still be on the old formula, right? You wouldn't have 100%
Right,
deduction
right.
this year, but you'd still have a benefit, right? And now that benefit at least will kind of cascade through the following years.
Yeah, and if I
Um,
have a blowout year next year, then I can go, I'm going to get that other piece of equipment or whatever it is and choose, do I want the 100% depreciation or cascade? Do you have a choice with the one big beautiful bill? I can go either way on the
you do
depreciation.
have a choice.
Okay.
You do have a choice, and that's the flexibility that I think that comes in. And typically, what we'll do is we'll work with whoever your accountant is or tax practice that you're working with, and just jointly look at it and say, well, what makes the most sense?
Right.
Right.
So what I am hearing you say is that year-end tax planning is important.
Very much so.
Okay. But
Yeah.
we've had this conversation a little bit, you and I personally. If we're waiting to year end to have that tax discussion, are we not doing ourselves a disservice? Shouldn't we be having those conversations throughout the year, and how frequently should we? Like if you were working with my practice, right? You work with me, but if you're working with my practice, how often should you and I be talking about whether it's taxes, investments? What is that? Because I know you approach this a little differently, which is why I'm asking the question.
hmm And I would say that on a quarterly basis, right, you should at the very least be taking a look and checking, am I, at the right spot, right? Did I withhold enough taxes already? Did I make my quarterly payments that's kind of covering where my revenue should be? That's where coordination with, accountants is, I think, valuable. You don't want to catch a surprise as you kind of get into the following year. Also, accrue any level of penalties and interest that you don't need to pay, right? As long as we're kind of staying on track. Investment wise, I mean, it's been a pretty choppy year,
Yeah.
right? So to just make sure that you kind of had the right perspective. And we had some practice owners in the beginning of the year, like right after tariffs, they're like, "Hey, get me out of the market." And we're like, "Hey, it's not the best idea. We don't just go selling everything,
Yeah.
right? It's not an emotion-driven kind of game, right? That I think investing really should be a lot more thoughtful about that.
Yes.
So, to kind of save people from just making kind of emotional mistakes, like the check-ins help, right? It kind of gives you a better sense of, okay, where am I? All right, you're still okay. The sky isn't falling, right? You're paying your taxes. How are you projecting for the year? Right? Because, these are considerations where you're right, Greg, like here we are. It's like almost Thanksgiving, and we have a very limited amount of time to make adjustments. As long as, if we've been doing it all the way along, then you don't have to kind of like all of a sudden have a fire drill in December.
Yep. Absolutely. So, um, two questions coming off of this. One is, who should I be, if I'm a practice owner, who should I be having those conversations with? Is it adequate for me to just be talking to my accountant Should I have a tax specialist and a separate investment advice? Like, in an ideal world, if you're telling me who I should be working with,
Mhm.
obviously you're going to say you, and I love that idea, but conceptually, who should, like, is an accountant fine?
Yeah, I think everyone kind of is good at what they do, right? And they stay in their lane. So, we give a lot of tax strategies and advice. We're also not the one doing the filing, right? So the accountant absolutely should be, one of the components of who you should be working with. The way I look at our role is we're like the quarterback, right? So if you think about it from that perspective, we have the macro view of a practice, right? The accountant is very granular about looking at the tax scenario and the tax situation. And a very important piece, especially when it comes to just making sure we're in compliance, that, the IRS and everything is, kept, in a good place, right? We're giving them the things they need and whatever, we don't trigger any audits or any of those things.
Yeah.
But in the end of the day, like who's looking at the bigger picture, right? And coordinating with the accountants. Attorneys come into play really if you're talking about, succession planning, right? Business planning, sometimes executive benefits, right? You could have a larger practice and there's some key people that we want to make sure that, they feel the love, right? And or potential, successors to the practice. But we're the ones who kind of have the conversations and say, okay, well, let's clue in. Let's go talk to the accountant. Let's go talk to the attorneys and just run the overall play to kind of help
Okay, got it. So, and then the second part of that question is, I would assume, but correct me if I'm wrong, that there is a separation between that kind of planning for the practice and that kind of planning for the individual, meaning so the dentist may own the practice, but the dentist also has personal tax returns, personal investments. The team members have those things. So, from a year end standpoint, what should the individual be looking at?
you. Sure, sure. And you're right, Greg. Like, I think there are certain things that everybody needs to look at, right? Whether you're a practice owner, whether you're a dentist in the practice, or just even any of the staff members that are kind of part of the overall. And we say, okay, well, what am I making this year, right? So I think the first step to anything, right, whether it's the business or the individual, is to just take inventory, right? Where am I so far this year? How much of my earnings? How much did I save? Right? Because these are things that are important. Many practices will provide a 401k. Did you actually max out on your 401k? Is there more potential deductions I could have just by doing that? You'll take a look, and many people have investments. So when they have investments, a lot of them, mutual funds, ETFs, they could distribute capital gains, right? Like mutual funds every year will distribute capital gains, interest income, and dividends, and you'll get a nice 1099. Well, most of the time they'll announce that in November to December, whether or not they're distributing that. So as a regular practice for us, when we see these notifications, like we want to speak to clients and say, hey, this fund had a substantial amount of capital gains being distributed to you, right? Are there ways to offset it, right? So we call it tax loss harvesting,
Right.
right? So is there losses that are in there that we can take, right? That at least for this year can offset some of those tax implications. Things like gifting, right? Gifting to children, gifting to family members, putting that money in a tax efficient vehicle like a 529 plan if you have kids that you're saving for, charitable giving, right? So, I know a lot of practitioners that regularly every year they put money in donor advised funds,
Mm-hmm.
right? How am I using that as another deduction? And how you determine that is just to say, well, how far over am I? You take a look at the tax brackets, And I think that's the thing. It could save a good amount of money. If I'm only 20,000 over, a tax bracket, right? And then if I can find deductions by putting money away in my retirement accounts, making charitable deductions and other things, you bring yourself lower. It's basically putting money back in your pocket.
Okay, so let's talk about gifting a little bit. Gifting in 529. What are the limits there financially and age wise, right? So the example is my twins are now 30. I'm assuming I can't gift them as much as I could, or maybe I could if they were 12, or maybe it's vice versa. What does that look like from the individual standpoint, from a gifting standpoint for our kids? And can that translate down to grandchildren?
Sure. Annual gifting is open season, right? And the annual gift is currently 19,000, right? It keeps being inflation adjusted.
Okay.
And annual gifts you can, in theory, give to, anybody. Like, Greg, if I had enough money, I could technically give you 19,000 and I wouldn't be subject to any level of gift tax.
Okay, so I'm going to call Gary, our CEO, right after this and say, you
Yeah.
should gift me
Yeah.
$19,000.
It might help your taxes, right? Yeah, sure. Why not, right? And so it is a strategy that makes sense, especially, a lot of times we'll see people who have substantial assets and they're allowed a lifetime gift exemption, right? As part of the One Big Beautiful Bill Act on a federal basis. By next year, it's 15 million per person.
Oh, wow. To or
So
from.
it's a lifetime gift exemption, meaning that if I had less than 15 million in assets, that I don't have to pay a state tax on that. Federal, federal estate tax. Some states have their own.
As the individual who's gifting. In other words, that $15 million limit is from the gifter, not the receiver.
Yes, correct.
Okay.
Okay. And ultimately, let's say husband and wife, that's 30 million. That's a lot of money. But there are people even that exceed that, right? And they
Yeah.
say, well, how can I continue to pare down? There are some people who don't exceed that, but right now it's still being proactive. And, listen, you're saving money for your children anyway. You may be giving money to help your parents, right? Just to take
Yeah.
care of themselves as they get older. There's a lot of reasons that people gift. And knowing that I can gift 19,000 a year, like my brother years ago had to buy a house. Well, I gifted him and his wife, and between two people, if it's 1919, I could give 38,000, no problem. If I wanted to include his three children, now you tack on another, you know, 27, like 57,000, then you all of a sudden can gift
Okay.
a good amount of money on an annualized basis, and there's no tax implications for that gift.
Got it. All right. So now, and you're going to potentially shoot me down on this question, but I'm going to ask it anyway. So I'm a clinician and I have four team members. I don't want them, I want to, for lack of a better term, I want to bonus them at the end of the year, but I just want to personally gift them the money. Is that, or because my understanding is from a practice or company standpoint, if I issue you a bonus, there are payroll taxes on that bonus. Can I gift my employees or does that send up a red flag? Is that a concern? Is that an audit issue? What does that look like?
Yeah, from a business perspective, you don't typically gift, right?
Right, but if I, as the clinician, like on the side, write a personal check to my four employees, is that an option or does that set off some alarm bells?
It is an option. Now, the question there is, would that actually be a deduction because it's a gift, right? So it
Right.
is now not a business expense. So whenever we kind of look at practices, a lot of it, when you take a look at payroll and wages that are distributed, bonuses that are distributed, a lot of it is, well, yes, they deserve it, right? We should be giving them, money if they've been doing a great job or they're a great asset to the practice. You also want to hopefully realize some tax benefit from that and be able to kind of offset revenues with that. So, yes, the added cost of FICA and other kind of payroll taxes that are there, that is, the downside of it. But that's not to say that because of that, I'm going to forego a deduction, right? And then be
Right.
able to kind of, put that away for them. And there's various ways to give monies to, staff members. I think one thing that is interesting, like in that manner, is part of the One Big Beautiful Bill Act. There is the ability for employers to be able to help employees pay back student loans,
Yes. Yes. Let's talk about that a little bit.
right? That's an interesting one that, kind of came up. And I think the limit on that is like 5,250 that you can kind of be able to give to an employee to say, hey, you're using this to pay back, your, dental school loans, right? It is fairly common for many dentists to graduate and come out, and they have some level of a loan balance.
Yeah.
And I think what we're looking at is saying, well, how do we create this as an incentive for them? When we're interviewing potential new recruits and saying, well, we have a loan repayment program for you. And in that manner, you're able to give, let's just say round numbers, $5,000 to the new practitioner. You're able to take that as a business deduction, but then they're able to get that as a tax-free piece.
And if they're making their payments regularly, that whole thing can go to buy the principal down.
Yes.
Okay.
Yeah. So I think that is a good potential lever, right, for some practitioners to say, well, you know what, it gives to them on a tax advantage basis, so they should be happy, right? Because every other penny you're giving them is taxable. And then for me, I still get a $5,000 deduction kind of to the business. So, I think that was an interesting piece that was kind of as part of that bill.
So are there
But I
other
wouldn't I
pieces?
wouldn't just gift 19,000 to folks because
Yeah.
that's
I'm
you
still
still want
waiting
the
for you to
deduction.
send that to me. So
Yeah.
so are there other I know we're shifting gears here a little bit, but I think this is great. Are there other considerations in the one big beautiful bill that we should be thinking about preparing for next year?
Well, I mean, you're talking about a kind of very large, very kind of comprehensive kind of bill. Um, I think a couple of the key points that are food for thought, right, for practitioners
Hmm.
is one is qualified business income, right, QBI. So qualified business income was actually done in the first Tax Cuts and Jobs Act that Trump had in his first term.
Okay.
And what that allowed is that for qualified business income, you're able to kind of take 20% of that income off of your taxes, right?
Okay,
So,
and what qualifies me for QBI?
yeah, so it depends on, for small businesses in general, there isn't really a cap on that. But
Okay.
for dental practitioners, it's a little bit different, right? Dental practitioners fall under like what they call special services,
Okay.
right? So with special services, there is a income threshold and there is an eventual kind of phase out. So for them, I think on the individual side, it was about like 241,000. And then it kind of phases out. The phase out starts at about 191,000.
Okay.
If you're married filing jointly, the phase out starts at about 383,000. And it's like 433,000. That's like, I think 433.9. That's kind of the high number where it's completely phased out. So it kind of really, again, as we sit here talking about year-end tax planning, it becomes all the more important, right? Because if you were a practitioner that was making 500,000, and now through the use of increasing maybe your retirement plan savings, right? Implementing a defined benefit plan to get that extra bigger sum of a deduction, to be able to take some of these, write-offs, right? The spend downs that we're talking about for equipment, and it puts you below that threshold. Now all of a sudden, a portion of that income I could take 20% off
You
of.
get an additional 20% reduction in your revenue.
Yeah. I think
Okay.
QBI is probably the one that is like the most immediate in terms of impact. We already talked about the 100% depreciation. That's another piece that's there. For anybody that's living in an area that has high, local and state taxes, salt deductions, right? That was like a big sticking point,
Right.
right? For a lot of the politicians, that salt has to be increased, so it's increased from 10,000 up to 40,000. And that's another one though, right? Up to 40,000, but if you're making over $500,000, then you're back to the 10,000,
Right.
right? So the number of reasons why, as you're getting up there in, earnings, the more you can pare down and put yourself below some of these income levels, now all of a sudden, 20 or 30,000 from QBI, right? 20 or 30,000 from salt. Like it adds up to real dollars that, it's extremely important. Like we always tell clients that I can tell you that I'll make you 2 or 3% more on your investments than the next guy. And, our goal is obviously to do better, but if I could tell you that we're going to look at it so that you can save more on taxes and reduce that drag, that's going to kind of get you to your goal faster, right? So it's really
Right.
a two-prong approach. That's why taxation and understanding these rules and regs are extremely important to kind of what we do for clients. When it comes to the One Big Beautiful Bill Act, the other thing to kind of just look at would just to be like, what are the effects of some of the itemized deductions, or what you're able to kind of reduce on that end, and that's just for everybody, right? For employees that are working, that might be listening to this call. Well, there's also some of the benefits now on overtime, right? And being able
Right.
to kind of have maybe 12,500 of that not subject to taxation, right? So for, overtime pay, qualified overtime pay,
Right.
little things that are there.
I'm looking for specifics. What are some things we should consider this year doing in the next 30 days versus deferring to next year from whether it's a tax saving investment? I want to know. Tell me, Greg, what should I be doing or thinking about over the next 30 days versus pushing to 2026?
Well, I think doing it over the next 30 days as opposed to 2026, there's a lot of it is the normal stuff, right? The charitable giving, the maximizing on any retirement plan deductions, the gifting, because that's an annual number. So, and these are annual kind of occurrences. Like they all should kind of do it. I mean, when it comes to, I guess, larger income folks, and if you're doing charitable giving, it may be better to do charitable giving this year versus next year, right? Because there are some limitations that are going to be
Okay.
put in place next year as part of the bill change on maximum deductible amounts, right? That
Okay.
are there. Outside of that, um, not a great deal, I think will make a huge impact for any individuals. I think just like, your medical and dental habits, right? Like brush your teeth 2 times a day, floss. Like my dentist yells at me, I don't floss every day. I floss like 3 times a week. But, these are kind of things that is kind of making sure you improve your dental health. Well, our goal is to try to help you be able to make sure you're doing the things that are improving your financial health, right? And these year-end pieces, they really can be, a little bit for some, a lot for others. But the fact is that if we could put even $2,000 back in your pocket, that's, substantial, right?
Yeah,
Depending
it
on the
is.
person that's there.
Absolutely. Okay. So, end of the year, last question for you, and then we'll wrap up. But um, I have gotten into the habit, and I want to know if I'm missing anything. So, I've gotten into the habit over the last maybe decade or so of end of November, right after Thanksgiving, is kind of a self audit. Like, I take a look at the investments, the taxes, but I also look at, where are we with the will? Is it up to date with the all of those? Does my wife have access to all of my financial accounts? What are some of the top things? Is there a structure? Because you kind of recommended that at the beginning as well. The end of the year is a good time to almost do a personal audit from your sort of financial legal structure for yourself personally. What are the big areas that we should be thinking about there?
Yeah, that's a good question. I think that it's a good practice. I'm glad, Greg, to hear that, at least, after
Doesn't mean I think
Thanksgiving,
of everything, but
yeah, I give thanks, and then I remember all the things that I'm like, oh man, I don't know if I should be giving thanks for some of this, but
yeah.
the reality is that it is important. And you touched on a couple of them, right? So we already talked about a few of the things that you should do. Tax loss harvesting, I think a lot of people miss out on that. They
Okay.
just kind of let their investments go. And listen, if it's in a retirement plan, you don't have to worry so much because you're not paying tax on that money. But anything that you have in a brokerage account, right, you really should see, because some of these things really, it might have created a 1099 that you don't know. If you sold a stock that you made a lot of money on, well, that's a pretty big cap gain. We come across that a lot, right? I mean, in the days, where people own Tesla and Nvidia and all of these, you sold 100 shares, all of a sudden it's like a 30, $40,000 capital gain. You should be going back and say, well, not everything that's in here was a winner. And, maybe I like the stock, but I can sell it now, take the loss. And then, you have to wait 30 days. It's called the wash sale rule. But then 30 days later, you could buy it back. You still claim the loss, right?
Okay. And with the
So,
given the volatility in the market lately, there
yeah.
may be some opportunity there on the tax loss
Yeah,
harvesting
I
claim.
mean, I think it's a very common occurrence that every year we're talking to clients and just looking and seeing, well, where can we harvest the loss to offset some of your gains?
Yeah. So even though
Right.
I may want to hold Nvidia long term, if I can take a loss now, 30 days from now, I can re-up on that.
Yeah, and then also sometimes if you have a very highly appreciated asset and you kind of want to sell it, but you're a charitable person, that's where donor advised funds come in. You could take a highly appreciated stock, put it in a donor advised fund, you sell it in there, there's no capital gain. Now, given that that money is for charity, but you could designate what charity over time. I want to give some to the, American Cancer Society. I want to give some to, the different charities that my church, things that you find meaningful.
Right.
It's another way to abate, right? Potential, like, hey, I made a ton of money and I love Tesla, but I don't know if they're going to keep going up right now. Like, there's ways to kind of just, take a look, and for every person, they're different. And you touched on, I think, a really important one, which was, again, just looking at your estate and just saying, well, are my wills in place? Are my, trusts and different things that are there? I always say the more complex somebody's situation becomes, if I start owning different properties, I have different business interests, you really should at least do a revocable trust so that you don't go through probate and it takes like a year and a half to kind of go through this process.
Okay.
Um, and, like for anybody with young kids, like I have two, I have a 14 and an 11-year-old. It's really important. Well, who would take care of the kids if for some reason my wife and I wasn't around?
Right.
How does that money get distributed amongst them? More and more common we see, um, modern families, right? Maybe it's a second marriage, maybe sometimes even a third or a fourth. There's multiple kids in different households. That becomes extremely important, right? Because I can't tell you how many estate litigations that we get dragged into because there's people fighting for money.
Yeah.
So looking over, your core documents could and should be an annual event, and for no other reason than you might have bought something new, right? I sold my old house, I moved to this new house. Okay, great. Did you kind of document that because your old house is still on the will, right?
Oh,
So,
right. Yeah.
updating kind of documents and updating your portfolios as they go. So it should be incorporated on some of the annual reviews.
Perfect. All right. So I'm going to put you on the spot here because I want to do this again. Only I want to go into some of the weeds on some of the things that we're hearing, and there's a lot of controversy around, meaning, when I think about 401k conversion to Roth, when I think about, right, there's conflicting advice on that all over social media. Should you convert? When should you convert? There's conflicting advice on trust, revocable trust. Does it make sense? Does it not make sense? So I'm going to ask you in front of everybody right now to commit to come back and do this in early January to talk about some of the more, for lack of a better term, controversial or topics around which there's a lot of potential misinformation out there, and help us sort through this.
Yeah, absolutely, Greg. I think what you just presented, we deal with on a probably day-to-day basis, right? Because, the internet is your friend, the internet is your enemy.
Yeah.
Social media, and I do believe that I look at it from a very simple perspective, right? Does it make sense? Doesn't it make sense? There's no blanket answer for everybody. We do the math,
Yeah.
right? And ultimately, you lay out the numbers and say, well, if I did convert now, how much am I paying in taxes? And how long does it take to kind of recoup those? But yeah, definitely we could find time. I know not for today, but we come across that a lot. I'd be happy to at least give you our perspective on it.
Yep. And that's what I appreciate about you guys. A, there's a comprehensive approach. B, that's not the first time you've said that to me. You do the math. Like,
Yeah.
the numbers just don't lie. So we will definitely link in the show notes to you guys if people want to reach out and have a conversation about what they should do either year end or as they prepare for next year. And Derek, I really appreciate you spending a few minutes with us today. And we're going to do this again, only we're going to get into some challenging stuff next time.
Yeah, I think the more challenging, the more fun. And I'll make sure that I bring another appropriate cocktail.
Yes, we'll have to do it a little later so you can do it from home and we'll have an actual cocktail.
Sounds like a plan.
All right. Thanks, Derek.
All right. Hey, cheers.
Cheers, my friend.